Hey traders, this is Blake Morrow with Traders Summit, and today it's a little early, but it is a holiday week here, not only in the U.S. but for everybody else. So I want to welcome Jim Welsh from Macro Tides. He's with us a day early. Hey Jim, how are you?
Yes, a day early, but that just means I'm that much more happy to see you, Blake.
Yeah, that's right. That means we're inching just a little closer to that time away, the much needed 2 or 3 hours away from our computers that we get.
Sometimes do feel like that.
It does. Hey,
Yeah.
listen, before we get started, and I know you brought up a lot of you brought a lot of charts to the table, but I want to talk to you about something. The talk right now is that there's going to be there's really going to be no recession, no landing. The markets or the economy is just going to kind of scoot on in, and I truly believe that one of the catalysts that has driven the markets higher this year has been the chorus of so many recession callers last year, so many macro economists just thinking, you guys keep your money safe, put it on the sidelines. It's going to get bad. It's going to get nasty. Every macro economist out there I say every, I'm saying that like
There was
90
a majority were definitely
majority.
in that camp.
And then now everybody's forced into FOMO, chasing the markets higher. Things don't look bad at all. Now you got rate cuts, that are getting priced in, and the markets are, look around and say, well, what bad is around the corner? So everybody's just kind of forced to chasing the market higher. But one thing that sticks out to me, and I remember a couple of things. I remember our conversations, obviously, but some key moments of it that always stick out to me. Like towards the end of last year, you're like, I think this market's going to rally above, 5,000 and towards where we're at right now, like 51, 5,200, whatever the number was at the time.
5219 was a target. Yes.
Yeah, and we're slightly above that, but it doesn't really matter because you were like, look, the market's going to get bullish, and then they're going to get lulled into this, and then all of a sudden the rug might be pulled out. Those things I remember, and also I remember. When you talked about a yield curve excuse me, an inverted yield curve a couple of years ago, maybe almost 2 years ago, close to maybe a year and a half ago, you said,
it was July of 22 when it inverted.
Okay. And so we're talking literally almost 2 years ago, like one point.
Coming up on it. Yep.
Yeah. And we're coming up on 2 years. And you said the average is 19 months, and we're right there at the average. So I guess the point I want to make here, and what I want to ask you is, with markets at these levels, everybody's like singing in unison, a chorus that it's time to be bullish. What can really turn the market? I sit here and struggle myself. And again, I'm not a macro trader. I tend to trade swing trade, and I'm more of a currency trader. So I try to position myself based on what central banks are doing. But I would say the majority of people, we look around and we go, I don't know what could hit us now. I mean, I struggle with it. So I'd like to hear in your words before we get into your charts, where you think we're at right now with the U.S. economy, global economy, and there.
Yeah. Well, the economy has held up better than certainly the majority of economists expected. They turned negative, or were expecting a much more negative outcome last year. The irony is that job growth last year was stronger, higher, more jobs on average per month last year than so far we've seen in the last 3 months or so. And so they've kind of shifted to, as long as the job number stays okay, the economy is going to be just fine. So I think what happens in the labor market is one of the keys to potentially changing the perception that we don't have to worry about a recession. So I agree 100% in terms of the shift we've seen in sentiment. And when you see so many people on the same side of the boat, if you will, I think for me, that's like, all right, now I want to start looking at, I understand that story, the narrative. What could undermine that narrative, and pay attention, if you will, to things that contradict that narrative. And that's why, the charts that I brought today are going to look at the labor market, because that seems to me, Blake, that's the linchpin that those who don't think a recession is possible at this point in time, the labor market is kind of where they're building their foundation from that. And so I thought, okay, the job numbers have been strong. As Powell noted in his press conference yesterday, Chris Waller, one of the governors, gave a speech, talked about, hey, the last 3 months, 275,000 versus about 230 the last 12 months. The labor market looks pretty strong. So that feeds into that narrative. So that's why I thought, you know what? Let's take a look under the hood, so to speak, at what maybe is going on in the labor market that implies that the headline job numbers may begin to soften in coming months.
I want to, some of the takeaways, I guess. Well, my main takeaway from Waller, and correct me if I'm wrong, he's the one that really did more of a dovish pivot at the at the end of last year, really,
right,
giving the market the belief that, hey, we're going to get a lot of rate cuts coming into 2024. And
right.
he said something, I'm not going to quote him, but
yeah,
not in his
paraphrase.
words. We're not in a rush, right?
Right. That I think was the title.
Oh, yeah.
No
Yeah, I
need to
guess it
rush.
was.
I think that was like the title. I reviewed the transcript of his speech yesterday afternoon, and I was heartened from the standpoint of a number of things that you and I have been talking about, how our inflation numbers, the last 2 months have not been very friendly. And guess what? The March numbers that'll be coming out, like for the CPI on April 10th, I think they're going to be, in a sense, worse. So you can ignore 1 month. 2 months is like you pay attention to. And that's what Powell basically said in his press conference, is he kind of dismissed January, but then you look at the average of January, February. But if you get a third month of higher CPI, three numbers denote a trend. So,
Jim, I don't want to hold your feet to the fire, because some people are going to be watching this, even though the video will be out ahead of PCE. There's going to be a lot of people that end up watching this after the fact. Because it's their weekend reading, weekend watching, if you will.
Saturday.
Do you have any, since you didn't bring any slides regarding PCE, do you have any just quick comments before we go into your labor charts?
I think I had a slide last week, which is why I didn't have one this week, just because it's like I don't want to retread it. But again, the whole key is always looking at takeaway values. And so to me, what we're likely to see is no progress, and the core the headline might tick up by 1/10. So is that a bad number? No. But again, what Powell stressed in his press conference, we need confidence. What Waller said, I need confidence that the inflation numbers are going to come down. And, everyone got spoiled, including the Fed, with a consistent decline throughout much of last year. And now things are kind of flatlining and going sideways. So to me, the PCE from the Fed's point of view is going to be modestly disappointing, because it's not continuing to fall. So how the market decides to interpret a flat PCE is anybody's guess. What we've seen in terms of equities, it's just been, everything's bullish.
Well, okay. I appreciate that. And I appreciate those comments and, reiterating what you covered last week. Remember, you should be watching these videos every week. And if you don't, subscribe to the channel. It's free to subscribe to a YouTube channel. Just subscribe and then hit the bell icon, because that means you'll be notified probably on your desktop or your mobile when a new video from Mr. Jim Welsh is here. So, hey, Jim, let's go ahead and go into your employment charts and get into it. Okay, so the first chart you brought here is the NFIB unemployment rate increases 6 months after NFB hire weakens, as it did in February. So can you explain what we're looking at here?
Okay, this is the National Federation of Independent Businesses. Basically is the organization that surveys small businesses. It's important because small businesses create about half the jobs in the U.S. It's not the big companies, they certainly do, but it's the little guys that are growing from 5 to 10 employees and from 10 to 20 that really create a lot of jobs. So what they did in this chart is they inverted the NFIB number, which is the dark blue, all right, to make it align with changes with the unemployment rate. So what you can see is the last 2-3 months, that dark blue line has jumped fairly significantly. And what that means is small businesses are cutting back on their plans to hire. So it was in the 20% range for months and months and months. Now it's down to 12%. All right. So what this implies is when these hiring plans change with small businesses, it's a leading indicator of where the unemployment rate is likely to go. So they moved it 6 months ahead, and you can see the correlation going back to 1985 is pretty damn good.
Yeah, and I just want to reiterate to people, the shaded areas that you see here are recession periods. So this is obviously the GFC, about a year and a half of a recession. And then COVID would have been a little sliver somewhere around here. So all these spikes correspond with, a recession right on pretty much as you get into a recession. So very astute observation here, Jim.
Well,
should we move on to the next one?
I want to point out, Blake, is
go ahead.
I don't want to. I think the March employment number comes out next Friday.
Yes.
You got 155 million people working in this country. 0.1% is 155,000. So there's a lot of volatility in some of the payroll numbers. I'm not using these charts to say, oh boy, folks, be ready. The March employment report, when it comes out next Friday, is going to be weak. No, the time frame, as this chart implies, is what's likely to happen over the next 6 months. So that's the window I'm talking about, because for most economists and the Fed, they're looking at, okay, we're data dependent over the next 6 months to make a decision when we're going to cut rates. And most economists who no longer thinks a recession is coming, hey, as long as the job growth stays good, we're good. Well, 6 months from now, I think that picture is going to change. And we got, a couple other charts that we're going to review that surprisingly tell the same story.
All right. Well, hey, you brought them. So let's look at full-time employment here.
Okay. So here's what starts to happen in the real world. When businesses start to become concerned about the economy slowing, rather than laying people off, they reduce hours. And at some point in time, if you're an employee used to working 28 hours, now you're only working 20, and you're having a hard time paying the bills, you go get a second job, a temporary job. So at the end of a business cycle, what tends to happen is the establishment survey, which counts the number of jobs per month. If somebody gets a second job, they count that as a second job, even though it very well may be a part-time job. The household survey doesn't. So my point is the dynamics that go on as you hit an inflection point with the economy starting to roll over is you see a big jump in part-time work, all right? And you see a pullback in full-time workers. Well, guess what? And the other thing that happens is as you come out of recession, businesses are not certain that everything's going to keep growing. They hire temporary workers. Well, when you near the end of a business cycle, they get rid of temporary workers. So what have we seen? We've seen temporary workers have been being laid off aggressively over the last 6 to 12 months. And now if you look at the year over year numbers for full-time employment is negative. So again, the shaded areas that you pointed out on that prior chart, this goes back to like 1989, maybe.
Yeah.
You can see that these numbers weakened going into the recessions, the 2001 recession, the 2008 recession, which obviously blew up into a financial crisis. And so again, these are indicators that are forward-looking, that are showing us that some of the internal dynamics within the labor market are weakening or have already weakened, which implies that we're going to see more weakness. So again, where will job growth be 6 months from now? I don't think it's going to be, the last 3 months have averaged 275,000. We're going to be way below that. All right.
Jim, I didn't mean to bring up this chart so quickly, but
No.
this is
Okay.
explain to this chart. I'd like to know
Okay.
what this one means.
Yeah. This is pretty cool. One of the Federal Reserve did this analysis, I think, in 2008. And what they found was what I was describing just a minute ago in terms of that internal dynamics as the economy nears the end of a business expansion, hours are cut and more people take on part-time jobs. So what happens is the establishment survey shows stronger job growth, which is what we've seen. And I think that we talked about this in the last 1 or 2 weeks, where the employment, the establishment number is showing job growth, and the household survey is showing much weaker numbers. All right. So what this chart is showing is that the household survey weakens before the establishment survey. And you can see going into the recession in 1990, 2001, and we know what happened in 2007. The same thing has been happening over the last 12 months. The household survey has been much weaker than the establishment survey for the dynamics that we've just covered in terms of full-time jobs are going down, but part-time jobs are going up. Well, the establishment survey thinks, wow, gee, the economy's looking great. The household survey is showing much more weakness because it doesn't double count. When somebody gets a second part-time job, they don't include that. So I should have shown one more chart, which is the current one. I'm sorry I didn't do that. But in the April macro tides, which will be going out on April Fool's Day, I do have the chart showing where we are currently. And it does, in fact, show that the household job numbers have been fairly, I would say, significantly weaker than the establishment number. That's what happens at inflection points. And hopefully our discussion, is explained a little bit to those who are not, following economic stuff that closely, just what happens in the real world in terms of people trying to manage their business. You cut back hours, people then can't afford it, they get a second job, and that gooses the establishment survey, whereas the household survey weakens. So those are the dynamics that I think are in play, so that 6 months from now, is the unemployment rate going to be under 4%? I really doubt it. And I think job growth will be significantly lower. So if we really want to dent the certainty or the confidence that people have that, hey, we don't have to worry about a recession, in a handful of months, if all of a sudden job growth drops under 100,000, that's a big deal. We need to create about 100,000 jobs a month, Blake, to absorb new people coming into the labor market. So if you have less than 100,000, that means all of a sudden people are getting in line to get into the labor market, and they're not finding jobs as quickly. When they get laid off, they wait longer before they're able to find employment. So again, all this stuff implies to me that we're going to see the labor market weaken, and I think be much weaker when we go out 6 months from now. Will it show up in 3 months? Somewhere out there we're going to see job growth weaken. So what I would say is when we get that employment report for March next Friday, one of the first things I'm going to be looking at is what happened with the household survey.
Okay.
Are we, because those numbers bounce around. So, but the trend has been in place long enough, Blake, that even if it upticks 1 month,
Yes.
It doesn't necessarily change the overall picture.
All right. Well, Jim, I appreciate you explaining that to us. I felt for a moment like I was a teenager and you were my dad saying, let me explain to you how things work in the real world. But you make some very, very great points there. And I appreciate it. And remember, you guys and gals listening at home, if you like what Jim's doing, make sure you give him a big thumbs up and jump down in the comments below if you believe something different. But Jim, I want to go to your technical views because we are at the end of month, end of quarter. And the dollar has been strong. Now, we're actually speaking right now as a lot of these flows are going through. The dollar index, came into this week pretty strong. And do you expect further strength?
I do. The last 2 weeks we talked about, hey, there's an ABC, only 3 waves down from the 104.97. That implied that the rally from 162 to 104.97 was the first part of a retracement rally off the decline we saw from 107.34 to 100.62. So in my view, this is an A, B. We're going to see that we're in the C leg. I think I think the probability of the dollar index getting above 104.97 is really, really high. And if the two legs were equal at 106.71, I don't know if we're going to get that high, but at a minimum, we should get above 104.97. I think the 105.75, 106 range seems pretty reasonable as a realistic expectation. And so again, if the inflation data doesn't come in friendly, perceptions of how quickly the Fed is going to move will get pushed back. And that's what Waller said in his speech. Bostic, who I believe is the Fed president of Atlanta and is a voting member this year, he said, I've gone from 2 to 1 cuts. So again, we're seeing this stuff beginning to unfold. And I believe if the inflation data comes in a little hot, especially that March CPI on April 10th, that, I mean, to me is what potentially gives the dollar a lift further. Once this rebound is over, my view is that the dollar will then subsequently decline below 100. Again, tied in with the idea that over the next 6 months, I think the economy is going to start to slow more than people expect. And our review of the labor market, is one of those reasons.
All right. Well, the dollar does look constructive, and I think 106. I'll be happy with 106 and change. So I'm just saying. I'm just saying. But
Yeah.
how about gold?
Not
Gold
speaking from position or anything, of course.
No,
but...
I'm not speaking my book. Gold is very bullish though, and surprisingly, the dollar strong, gold continues to be very strong as well. So, what are your thoughts here?
Well, again, chart wise, what I said in this week's weekly technical review was as long as we held that 2140 or whatever that recent low was.
Yeah, it's 2145.
Push
I think. Yeah.
above the 2210 was coming. It got a little bit above that. I basically have said when gold gets up to 2240, sell the other half. So, I basically instructed people to get long when gold was trading probably at 2030 to 50. And then sold half of the position last week just above 2200. And if the gold gets to 2240, to sell the other half. I think once this move up from the low we saw in February is complete, we're going to see a pullback. My guess is 2100, just because of the chart analysis, the breakout, and all that happy stuff. So I think the gold is getting near what will be, I think a decent trading high. And then longer term, I'm still bullish. I think there's a pullback coming in gold. And after that, I think we're going to see higher prices.
All right. And the next chart you brought the 30-year yield. So what are we looking at here? And this looks supportive of, potential US dollar rally. So
yeah. Well, again, Treasury yields declined from the high last October to late December in 5 waves. All right. So now it was a question of, and back in December, we're going to see yields move higher. They have. The pattern, I don't believe, is complete yet. I think we're going to see one more leg higher on Treasury yields. At a minimum, it should get above that 4.505 yield, and it could get up to 464. And that's a target based on 419 to 449 is 30 bips. Whatever the low is, this morning the low is 4.344. If it drops further to 432, add 30 bips to 432 and you get 462. So my take is somewhere above 450 is where I think the 30-year is going. Once this upward correction is done, again, my economic analysis that the economy is going to slow more than expected. I think Treasury yields are going to drop below where they were in December. And so to me, the peak in yields that we're approaching is going to represent a buying opportunity for another rally in Treasury bonds.
All right. Well, let's see what happens, on above 450. I think that's going to be pretty important, as you suggest.
Yep.
Last but not least, we want to know where stocks are going, because the stock market has been nothing but net, Jim. Nothing but net.
Yeah. A lot of 3-pointers, man.
A lot of 3-pointers here.
Okay. In January, first week of January, I went through if you will, the calculations and said the S&P could get up to 5219. And obviously we did that in the last week. Last week's video, I said, you've got a triangle here, A, B, C, D, E, where I believe is wave 4 of the move up since the low in February. And the news with the FOMC, the S&P rallied at 5261. Last week, my take was, I think we have a pullback, and the chart implies we're going to see another move above 5261. The triangle targets a high around 5287. So from my perspective, we're nearing the end of a 3-wave rally from the October of 2022 low. One or two things are going to happen. We'll have a pullback toward 5,000, whatever the number is, and then we're going to new highs. That's the bullish pattern. The bearish pattern is we're going to make this high, and it's the end of the rally from October of 2022. So for me, it's like, all right, both the bullish count and the bearish count imply a pullback. The only thing we don't know is it going to be 5 to 10%, or is it going to be something much worse? So to me, this is getting above 5261 is, I think, a place that people should be selling into, and aggressive traders can take a short position. I'd use a stop at like 53.50.
Which would be the top of the channel, something like that.
Yeah, maybe just a touch above it,
Yeah.
So again, I to me, a lot of things seem to be aligning in terms of chart patterns. And like I said, the PCE is not going to give the Fed more confidence. It's not going to maybe dent their confidence. I think the March CPI on April 10th is going to be the number that it's like, whoa, wait a second. The market is happy with the idea we're going to get our 3 cuts. And as we discussed last week, and it's interesting, Waller talked about this in a speech. I went through the dots and said, the median stayed at 4.6, but there was a lot of upward movement if you looked at what those individual dots represented.
Yeah.
And of course, that was just completely ignored. And that's why, again, when I read Waller's speech yesterday, it's kind of like, okay, he's talking about that. He noticed it, that his other fellow FOMC members, are dialing back rate cuts.
And I'm going to say, Jim, to your defense, you were talking about this last Friday on CNBC all week. I heard the people that were talking about dot plots all mention the same thing.
Yeah.
Like throughout the course of the week, people started going, oh yeah, oh yeah, oh yeah. I mean, the median has shifted.
Right.
Just one real more shift, and next thing you know, everybody's
one more person changed it would have been more towards 2.
Yeah.
No, I mean, you and I, we've been doing this now for a while. And, as in early 2022, everybody, Goldman, the Fed funds future, we're talking 3 rate hikes in all of 2022. And in January, I said, no, we're going to see the Fed front run and front load the hikes with March, May, and June of 2022. They not only did that, they increased the amount. So in terms of Fed analysis, I think I have a really good understanding of what these guys are thinking about and why. And at inflection points, that's really, really important. It was really important in 2022 to see what was coming. And I think we're at another inflection point over the next 6 months.
And just remember, guys, if you want some of Jim's insights, you should send him an email at jimwelshmacro@gmail.com. Is that it?
Jim Welsh Macro at Gmail. Thank you.
Yeah, send him an email, request the most recent macro tides, and then also say you're a viewer at Trader Summit. I'd appreciate that.
Discount.
Anyway, yeah. Jim, I want to say happy holidays. Happy Easter. I know you celebrate Easter and happy holidays to all of our viewers, whatever holiday you happen to be celebrating this week. But I want to say thanks for taking the time out and joining us. I look forward to speaking with you next Friday.
You got it, buddy. Thanks, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.